Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy any investment based solely on a tip or recommendation. Please do your own research.
Good afternoon and welcome to another edition of the Sunday Roast. It's February the 19th. I'm Phil Carroll.
And I'm Kevin Hornsby.
In the week that we saw Sturgeon stand down after bitter S&P divisions.
Did she ever stand up?
No cranky jokes, no cranky jokes. Rishi holding talks in Northern Ireland with talks of a deal with the EU on post-Brexit trading arrangements, aka Northern Ireland Protocol, and Centrica announcing profits of £3.3 billion. What are your thoughts on the last one? Any of those really, but I think the big one was obviously Centrica / British Gas announcing those profits.
Yeah, it was inevitable, wasn't it? You know, gas price was absolutely huge, and what they've been charging people is absolutely huge. So they're going to make a big profit.
And now you've got all the media, the usual whipping up a storm saying, MPs, poverty campaigners call on the British gas owner, Centrica, to use its record 3.3 billion profit to compensate vulnerable families forced onto prepayment energy meters, which is an absolute, yeah. I mean, this is mad. And then the next one is they're asking the chief executive, Chris O'Shea, to look at his conscience and refuse to collect his bonus this year.
So they're going to say the same to EDF, who I think are they French owned or German?
And Ineos as well. You got the Ratcliffe as well. As if these bosses are suddenly going to go, yeah, all right, there's my 1.7 million back.
I think it'd probably be more than 1.7 million, but yeah, it's like no.
Okay,
I mean, it is what it is, isn't it? And I mean, I think the good news is probably that the gas prices have come down a lot. Yeah. So the threat of everybody having to pay, 5,000 a month, 10,000 a month, or whatever, has passed us by. Yeah, and
that segues nicely actually onto what you just said about the prices. That Putin losing the energy war as the European gas prices have hit a 17-month low. Dealing a blow to Putin's efforts to fund his war in Ukraine, because obviously the demand isn't there, the prices aren't there. He's not getting the same money. So what are your thoughts on that one?
Yeah, I think everybody's cut back, haven't they? I don't, even here, even though it's not gas, it's electricity, but we're just not using as much. Being careful whether the lights, heating, whatever. You're just putting it on when it's required, rather than sitting in a snug house all day when it's very when you need to. So I think everyone's cut their cloth, haven't they, because they think it's ridiculously priced. So that must have had a big impact on demand and hence prices. And they found some solutions, I think. Surely people found solutions to sort it out. So
I think it was a good wake up call anyway in that respect. As you say, the reliance on the Russian gas, and they've put other measures in place, as you say. So the other one this week, which was great, was obviously seeing the FTSE 100 close above the 8,000 in a record first. But it failed to hold on to those gains, with falls in banking companies dragging shares lower, namely NatWest on Friday. So great to see that, isn't it?
Yeah, it was good. It's only taken how many years? About 17 years or something silly like that. But yeah, it's good to see it. I mean, it's absolutely crazy that it's taken as long as it has. But yeah, Friday, it was trying its best to close above 8,000 again, 79999. I think it's a psychological level. And once it goes above it, then there'll be price finding, and it probably will go up another 10% easy, I think.
So, yeah, the Met Office has issued a weather warning as Storm Otto is set to lash the UK with winds in excess of 75 miles an hour, Kev. I mean, that's a serious bit of stormage coming our way. There's obviously lots of insurance claims are still unpaid from the last storm, which brings us neatly onto this week's guest. We're joined today by Craig Foster, CEO of Ondo Insurtech. Welcome, Craig. How's things?
Hey, Phil. Yeah, very good. Hey, Kevin. Nice to meet you all. Thanks for inviting me on the podcast.
Hi, Craig. Tell me this: Have you ever had your ceiling fall down from water damage?
Do you know what? I haven't personally, but as you would imagine, I've seen a lot of people who that's happened to. But do you know, my dad actually lives near the banks of the Humber estuary, and a few years ago, I don't know if you remember, there was a tidal surge. And it just washed through, and it was, I wonder how many insurance claims happened just in that one village. Like, it just totaled my entire dad's house. It was like an
Whoa.
£80,000 insurance claim. So yeah, it's amazing the damage that water can do to a property. Yeah,
I must admit, I've been reading about the technology, and it's pretty exciting and also very innovative. So let's start at the beginning. Ondo is a London-listed, so main market standard list company that's created a patented water management security technology called LeakBot. So go on, what exactly? And I'm probably a lot of listeners are thinking, how does it work? What is it? Let's give us a lowdown, Craig.
Yeah, sure. So our business, we're in the business of preventing water damage claims for the insurance industry. So specifically, we're focused on the claims that are basically caused by leaks on your plumbing. So if you imagine, Phil, in your own house, you've got loads of pipes hidden in cavity walls, hidden in ceilings. And the thing is, you can't see them. So what tends to happen is those pipes start to leak, but you just don't notice. So over time, the drips will happen. And sometimes it's going for weeks or months. And one day you'll move a bit of furniture or you'll get something out the back of a cupboard and realize that something's getting damaged. That causes just an unbelievable amount of insurance claims on home insurance. So it's about a third of all the claims on home insurance. So 30%, if you add together the US and the UK, just to put it in context, it's about £14 billion worth of claims every year from those types of leaks. So we developed basically a system designed to prevent those claims. So yeah, the technology, Phil, that you're asking about is essentially it's a small sensor that we developed. It's small enough so you can just send it in the post and it just clips to the pipe. So it's a self-install product. So you clip it to the pipe. You know where you stopped at, where the mains water enters the property, normally like under the sink or something like that. And that single unit can detect a leak anywhere on the mains water system. It's dead sensitive, so it'll pick up a leak down to about 3 milliliters per minute. So just imagine like a small drip. And basically, we invented that technology. So we own the patents on it all around the world. And I think it's, as far as I know, it's the only way that you can detect a leak to that degree of sensitivity with a non-invasive technology, without someone cutting the pipe, like a professional plumber actually having to physically install something.
Yeah, I mean, how does it exactly detect it then? Is it a difference in flow rate? I mean, how does it work out even something as small as a few drips are leaking?
Yeah, so it basically works via temperature.
Oh, wow.
So the story to it was we were trying to figure out, we were looking at other leak detectors on the market, and there were either these expensive ones where you plumb them in and cut the pipe, or there were like these moisture sensors. It's an old technology where if you put water and it connects a circuit on two metal prongs, and they had the idea, well, let's connect that to the internet. There's loads of them, but they're only good if water escapes on top. We collaborated with a kind of PhD brain box guy called Sam Bailey. We said to him, can you think of a way that you could detect a leak without actually having to cut a pipe? So he experimented with a bunch of different ways. And then he came up with a new idea, which was, what if we measure the temperature of the pipe and then we compare it to the ambient temperature where the device is located? So his basic idea that he thought of is, well, every time you run water, the temperature of the pipe chills to the temperature of the incoming water. The ambient temperature is relatively stable. What his hypothesis was, and he turned out to be right, is that if there's no leaks in the property, so do you think you go to bed at night time or you go out for a couple of hours, there's no flow of water through the pipe. So the pipe warms back up to the ambient temperature. So you see that on the signature, if you're measuring the two temperature readings, they close back up to an equilibrium point. What he realized is if there's a leak somewhere in the property, and it doesn't matter how big the house is, it doesn't matter how small the leak is. It can be, 6-bedroom house and on the 3rd floor. But if there's a tiny leak, it's permanently pulling water through the pipe, which creates a permanent temperature differential. So the two temperatures never go back to an equilibrium point. So we tested that. We realized it worked. We filed the patents on it. And then subsequently that's rolled on, and we own the patents on that all around the world. And the great thing about it is it means it's a low cost way that you can send something in the post and someone can install it. We get about 80% self-installation rate with it, but that single unit can detect, turns out, exactly the leaks that cause insurance companies the claim. As a result of that technology, of which we're the only provider of it, we've really got the only kind of scalable go-to-market model that actually works for insurance companies to solve that problem.
Okay, so say it detects a leak. Presumably, is it battery powered? Do you have to replace the batteries every year, and is there a low battery warning on the device?
Yeah, so it's powered. The sensor itself is powered with 2 AA batteries, and they last about 5 years.
Yeah.
So the way that it works is the unit connects over your Wi-Fi, and then to install it, basically use a smartphone app to install the device. So the installation process takes a couple of minutes. So you can see the status of the property, the flow rate of the water, that kind of thing. But then if you have an actual problem when we detect a leak through the app, you can then book a plumber to come to the house and to fix it. You know, it sounds quite unbelievable that you can connect it on Wi-Fi and the batteries last 5 years, but how it's actually working is, anything that's connected to Wi-Fi, would drain a lot of power. So how it's actually working is it's running locally on the pipe with a very, very tiny power consumption. If it detects a problem, it wakes back up and then sends a very small data packet through the Wi-Fi router. And if there's no problem, just once a day, it sends us a small message back to our servers. We can kind of piece the history back together just through those small data packets. So it's not actually connected all the time. It just connects for like a couple of seconds every day.
Very good. So tell us, I mean, it's fascinating what's happening. And obviously, this guy came up with a masterstroke of an idea. But how did all this come about that you ended up being on the stock market and singularly for this purpose? Because I would imagine this process would have happened within a bigger company, that they discovered this.
Yeah, I mean, we're a slightly odd story, really, because of where we started out. So I originally at the time was working for what until recently was a FTSE 250 company called HomeServe, founded in the late 90s, grew really quickly. And that company basically, it was a guy called Richard Harpin who founded it. And his idea was basically, it's kind of like a membership service for plumbing. So, and it was sold through water companies. So everyone will probably have had a lot of these from the water company, offering you plumbing cover for, £1 a month or something like this. That business ended up a really, really big business. And Richard asked me to set up an innovation lab for them. And I think the fear from HomeServe was they could see the risk from the Internet of Things to the business. So if you think of, say, connected heating, if a boiler is going to be connected to the internet and you've got a big business on basically boiler cover and boiler services, if somebody can access those fault codes remotely all of a sudden, that's suddenly a massive risk to your business because they've got a different kind of way of getting to the market. I was asked to set up an innovation lab. I did a bunch of other things for HomeServe, but they asked me to set up an innovation lab with that kind of broad remit to kind of forge new partnerships and see how the Internet of Things could be an opportunity for the business. So most of the things we did were actually related to connected heating. We took our own equity stake in a German smart thermostat company called Tardo. And you remember when Nest thermostats were first bought by Google? They wanted to launch in the UK. So I built the first installation network of electricians who could fit kind of smart devices. But we had this kind of crazy side project where everything we were doing was on heating. And we thought, well, what about plumbing? Could you imagine plumbing also getting connected to the internet? That's where we kind of had a look at the other products that were in the market, realized they weren't actually very good. So we kind of thought, well, let's try and see if we can find our own way of doing this. And that one thing led to another, basically. I mean, we started out by having this early version of the product that was effectively like a Raspberry Pi circuit board in a big box. And we realized we were onto something, especially when we realized we filed patents on the product. But it was the classic thing where we realized there was a much bigger problem to solve with the product. So originally we were thinking, this could be a nice kind of add-on product for a HomeServe policy or something like that. But we realized it solved this much bigger problem for the insurance industry. So if you fast forward a couple of years, I mean, HomeServe have just been bought by a massive Canadian conglomerate called Brookfield. So on the run up to that transaction, there was obviously a tidying up going on, and we kind of didn't fit very well with the business's strategy at HomeServe. We basically created a B2B Insurtech business, which was quite distant actually from the consumer company that HomeServe was. So it created this opportunity. I had an advisor who's now our chairman, a chap called Mark Wood. So he's kind of insurance industry veteran, used to run AXA. He was the CEO of Prudential. He actually is now the non-exec chairman also of PensionBee. So Mark and I kind of pitched to HomeServe and said, well, look, if we can find investors, could we carve the business out and run it as a separate thing? Now, honestly, we never thought in a million years that we'd end up as a public company. Full disclosure, that was not like where our minds instantly went to. what happened was there was a cash shell on the main market called Spinnaker Acquisitions, and they just done another deal where it's a medicinal cannabis company that they brought to the market called Cannabo. So I think a lot of the same backers had put a few million into another cash shell, and they were looking for a tech business that had some environmental credentials, which fit very well with what we were doing. So we fit their criteria really well, and they were kind of quick to move against some of the other kind of suitors that were involved in the deal. There were some strategic buyers that were interested, but the guys at Spinnaker just moved quicker. And so that's where we ended up. So we came on the market, can you believe it, in March 2022 as a brand new, very small cap company, literally at the moment when the bottom fell out of the market. So you couldn't make up the timing, really.
It was.
No, you must have been one of the last IPOs that actually got on the market.
I think we were, yeah. Literally like in the last few days, I think. I think it would have been a week or two later, it wouldn't have happened.
So that puts you in a position then of strength. Obviously, at that time, you had cash, I presume, from Situation. So how's that worked out since then?
It's two different tales depending on which way you look at it, actually. So obviously, with a view to us becoming a public company, we knew the first 6 months were going to be really key to getting off to a good start. So what we didn't anticipate is what was going to happen to the markets. So obviously, we were running up to that point where the transaction was going to complete, knowing full well that we had a load of deals kind of in the hopper that we had a good chance of realizing and being able to announce. So being new to being a CEO of a public company, I was kind of learning quickly, and everyone's saying, look, as long as you've got a good news flow and, it all builds to the overall vision of the company, then you'll get off to a good start. And then the funny thing that happened is once we were an independent company, everything pretty much went to plan. So we announced the deals that we expected that we would. We grew the business exactly in line with the strategy that we'd laid out in the prospectus. And every time we put an RNS out, it was absolute tumbleweed for the first 6 months. I think the kind of bottom fell out of small caps generally. Technology stocks particularly, no one was interested all of a sudden, where it had been the hottest thing to be for a long while. Yeah, we had no profile as a public company. So it was hard going at the beginning. But I think how we felt about it was, maybe that's just to do with market dynamics, and we just need to carry on, get our heads down and carry on building the business. So, from a commercial point of view, we've done exactly what we said we would do. So we've been growing the business in the UK. We announced a big partnership with Admiral recently. We've also got a good business in Scandinavia. So we announced a bunch of partnerships in Denmark. We announced the end of a pilot, and very recently we put an RNS out a couple of weeks ago about working in a rollout with the biggest insurance company in Sweden.
Let me just stop you there in terms of the insurance companies, okay?
Yeah.
Because the insurance companies are obviously interested in saving money in terms of these leaks. So when the internet flashes there's possibly a leak, are the insurance company also told about it? So it's not just on the bequest of the property owner.
Yeah, that's right. So basically, that to explain how the go-to-market model works is once a carrier signs up to a deal, they offer the device for free to their policyholders. So different channels, depending on the partner, there's slightly different ways of doing it. But they say, hey, great news, this now is part of your policy. We basically send one in the post and encourage the customer to clip that to a pipe. That then, most people will not have a leak, obviously. The insurance carrier can see that in the background. So they have really good telemetry data. They can see which devices are installed. Are they working properly? And importantly, they can see the customers that, great, this cohort don't have a leak. And like I say, given that it's the single biggest risk peril as far as they're concerned in terms of the claims paid out.
So just out of interest, when you sign up for insurance and they try and sell you a black box, which most people just refuse to have, is there some discount to the customer for having one of these, the LeakBot installed at their home?
It all depends. It's kind of insurance company led.
Sure.
So there's kind of different flavors. We work with 11 different insurance companies now, so there's slight nuances, Phil. Most insurers to start with have gone for a kind of proposition that says, hey, this is now with the policy, it's free. And by the way, even if we detect a leak, we'll even send someone to your house at no charge to come and fix it.
Sure.
So it's extra peace of mind, what's not to like. They found the take-up rates with that proposition are really strong. So they don't necessarily need to offer a discount to kind of encourage the customer to take it up. I mean, generally, it's very popular with homeowners. I think they're quite surprised to get a kind of cool looking gadget with an app and not have to pay for it. And then when we send a guy in a uniform, and the customer service on the repairs is really exceptional. So if you actually have a repair, have a look on Trustpilot yourself, you can see some of the customer reviews on there. It's overwhelmingly positive. So, part of the problem we have actually is just the skepticism of how can I have been offered this for free? We have to explain to customers why it's also in the insurer's interest, because that's one of the problems we have is there's a lot of skepticism. Like, it must be a catch. Like, there must be some hidden charges. If the plumber comes to the house, there must be. They'll be like, oh, now I have to pay £50 or £100. They actually don't. But, some people are inherently skeptical, aren't they? So we have to kind of overcome that as well.
So if a fault is detected then, or there's a leak or something, is there a set period that the homeowner has to act to get that leak checked by a plumber and rectified?
Yeah, there's not so much a set time, but we'll keep messaging the customer and encourage them. So what we actually ask them to do is we get them to do some diagnostics first with the app. We'll say to the customer, hey, look, we know that there's some kind of continuous flow of water somewhere in the house. First thing to do, just check these things. So have a look. Can you see any taps that have been left on? Can you look down each of the back of the toilet where sometimes the overflow's leaking, there's water just going down the back of the pan? Can you see anything like that? So remarkably, 60% of the things that we see, the customer manages to fix themselves. So the classic thing would be, so you've washed a car at the weekend, or you've been, filling the pond up a little bit, so, something like this, and you've left the outside tap on ever so slightly. That's, a common type of thing. For the customers then that they've checked, they can't see anything, but we can obviously see that there is a leak on the property. They're the ones where, we're really keen to get one of our plumbers into the property. And they're really trained. The guys that we send are trained on how to find hidden leaks. So we've even invented some proprietary technology that the guys carry on the vans, and it enables them to actually test the property in real time once they're there. And the reason why this is great is we found if you haven't got that, you don't know if you've actually really fixed the root cause of the problem. You can fix something, but, well, is there something else that's hidden? With this leak test that they use on site, they can fix something, test the property. If it still says there's got a leak, they can carry on going. So the insurers love that because it's quite binary. Like, we know for sure that we fixed the root cause of the problem when we leave.
This is fascinating. How do you make money?
How we make money. So it's free to the homeowner, but the very simple model is all of that's paid for. The insurance company pays us to deploy that technology and deploy the service. And the simple economics of that is it costs them less to pay us to do that than it does the savings that they get in the decrease in claims costs.
So per customer, I mean, are you charging the insurance company £149 for the unit, the same as to buy, or not? It's less than this.
Oh yeah, no, it's less than that for the insurance company. So I mean, as is always the way with these things, it's kind of volume related. So and some, like the deal we announced with Admiral recently was 20,000 units. So some of the deals that we're doing are into, bigger multiples of units rather than just, buying one on the website. The pricing model has evolved over time, and, every deal we've done is slightly different. So we've been kind of feeling our way on what's the right kind of pricing model. So we used to price separately for all the individual elements. You'd pay a certain amount for the unit, and then a certain amount for the software and subscriptions, and then a certain amount for the plumbing repairs. And I think what we've learned over time is that's just too complicated for the insurance company to kind of figure out how much it's actually going to cost them. So actually making it increasingly more simple is a good way to do it. I mean, if you look at our last interims that we published, we separated out kind of device and setup fees and ongoing revenues from the recurring connected devices. So you can kind of do your own maths and figure out what's the kind of averages. But it basically, like the recurring customer base is generating, somewhere around £1.50 a unit per month, and then somewhere between £20 and £30 for every unit that we ship immediately. Now, the reason why the pricing model is that way round is at the moment, we're trying to get to cash flow break even as fast as we can. So we're really minded to make an immediate cash margin almost have the insurance companies fund our working capital. So we always trying to make an immediate cash margin on the deal, and always trying to get the carrier to kind of commit to a big lump of devices and pay for it in one go to fund the first kind of rollout. Is that the economic model for where we would like to end up? I don't think it is, actually. I would rather, because we're charging an upfront, it means the recurring fees lower than it otherwise would be to get the overall economics for the carrier to make sense. So rather than charging, $30 or $40 in the first year and then $2.50 ongoing, I think where ultimately where we'd like to get is just to charge a flat fee of maybe $5 a month to the carrier. So the economics are actually even better for them in the first year, but the long run economics for that per unit, the long run kind of lifetime value of everyone we ship would be higher.
How many of these units currently are on the market? How many have you got?
I can't say as of today how many we've got live. We'll
go on, Craig.
Yeah, I'd love to. I really wish I could. But what I can tell you is at the time.
Okay, at your last audited figures, how many did you have?
So at the time when we did the RTO and came on the market, we had 32,000 kind of registered customers on the platform. By the time we did our interims, we had 46,000. So I think what I can say is that number's growing quickly. So, I mean, you can, without saying what it'll be, our full year runs to the end of March, the growth is basically accelerating. I mean, even that one deal with Admiral, we announced that was single client's going to ship 20,000 over 6 months. We announced that at the same time as those interims to the end of March last year. So it gives you a sense that, so that number's growing.
At least 60, 65, 70,000, even based on the Admiral one. You were saying that you expected $1.50 or £1.50 per unit per month.
Yeah, it's £1.50, yeah.
It's £18 or so per household per year.
Yeah, that's if you look at the existing economics, yeah. Yeah, and what we're doing is we're shifting that. So increasingly the recurring revenue, the service and software revenue is growing at a faster rate than the upfronts. So we're slowly transitioning more towards just the ongoing recurring revenue. It's a much better footing for the business as we grow to be growing that line faster.
Very good. So are there any other ways that you can see that revenue could be created in these situations?
Yeah, there's a few different ways to answer that. I mean, the plain vanilla model with the insurers is quite straightforward. So they pay that recurring fee for us to deploy everything as a kind of end-to-end system. And they're doing that on the basis of the value created from the claim savings specifically. So to give you an idea for that, say in the United States, there's about $200 of underwriting cost on a home insurance policy on average across the US. And we can reduce the claims cost on water damage by about 70%. So $140 saving in a year. And if we were charging $5 a month for that, $60 every year that we would charge the carrier. So, 100% plus return on investment for the carrier. So that's based on one specific benefit around the actual claims, the claim saving. There's other interesting things as the model evolves. Phil, you were asking about this a little bit. You were saying, do they offer a discount? Is there other ways that they can, use the data? So obviously, the data that we can provide is quite useful in terms of pricing renewal premiums. So if one customer's leak free and other customers had a leak for ages and not done anything about it, you might want to use that data to price renewal premiums. So you can imagine us charging API calls on the system to use the data for things like that. Other interesting nuances on the model as well. If things like using water companies, for example, as a route to market. Or testing actual plumbers, third-party plumbing companies selling the devices with a plumbing service. They're not different models altogether. They're complementary that we could use to build the relationship with insurers. So at the moment, we've kind of stuck to the plain vanilla model, but there's some really interesting ways that we can grow new revenue streams with, I think, with different kind of channels to market through water companies, through plumbers, things like that.
Based on once you've got cash flow positive, then is it more sensible then that you approach the insurance companies and maybe not just the platinum members of the insurance companies, that you actually offer this service for free no upfront fee, or actually maybe, £10 or something very small. And then, as you say, £5 a month, because obviously that's going to build your recurring revenues extremely quickly.
What's interesting is what we've seen with the partnerships that we've done. So our first rollout partner was Hiscox in the UK. Obviously, a really well-respected brand. And what we've seen is, we signed a renewal contract with them recently because they've been doing it for a couple of years. If you look at them, if you look at Lancer Schaffringar in Sweden or Top Denmark, we've seen them do the same thing where at the beginning, they always want to start quite small because they want to measure themselves. Are we really getting this claim saving? And compare it against a control group. And once they're confident, then they advance into bigger and bigger volumes. And what we see happens is that same thing happens over and over again. So if we're pitching to a new insurance company, it's always kind of the same. The risk is on them. So they tend to say, oh, well, we'll start small, we'll do a test. But over time, obviously, now we've done this with 11 different insurance companies in 3 or 4 different countries. We know how this goes. So I think one of the ways that we could really accelerate the growth a lot quicker than what we're doing today is if there's some way to kind of transfer that risk more towards us. If we were to, offer a guarantee to the partner and say, look, we guarantee that you won't lose money if you go bigger and go for a bigger volume deployment straight away. The only reason they start small is they just want some kind of confidence themselves that they'll definitely get the result that we're saying that they will. And also that's made harder, as you just suggested, because we're trying to charge them an upfront fee. So their margin is effectively tighter in year one than it is in the out years. So the combo of like a guarantee and then flat pricing, I think, is the way that we could grow a lot quicker, just through the existing model with insurance companies.
What number of units do you need to have to be cash flow positive?
We haven't put any forward projections or anything out in the market, but I mean, you can, from the numbers that are out there, you could do your own sums, Kevin, and anyone can take a quick guess at that. So if you were to do your own math, you may very, very well conclude that if we kept the pricing model as it was, from where we are now, if you add like another 130,000 customers or something like that, would be around the break-even point. If we actually charge less upfront and go for a bigger recurring fee, actually, obviously, a smaller number of recurring customers would be needed to get there. If anyone looked into just the deals that we've signed recently and the scale of some of them, you can see how there's a path to cash flow break-even just by executing on the deals that we've already done. I mean, just to give you an example, Hiscox is one of our first partners. They're effectively a high net worth insurer, so the entire book is only like 70-odd thousand customers, something of that magnitude. The deal that we signed recently with Lancer Schaffringar, most British listeners, I would have never heard of them myself if we weren't in the business, but they're actually the biggest insurance company in Sweden. So they've got 2 million home insurance customers. They've got a 30% market share. They ran a pilot in one. They're a strange business because they're separated into 23 kind of semi-autonomous regional businesses. So they ran a pilot in one region, and in that region, we penetrated 40% of their customer base during the pilot. We delivered the claim savings, also delivered a 50% increase in new business. And then we just announced a couple of weeks ago, we started the rollout. So we've already started rolling out into the second and the third LF regions. You do your own maths on the potential of like one partnership. If we sign up half of those regions, we expect more than half of them, we have reasons to believe we're already interested in the rollout. 40% penetration of a couple of million customers adds up to a big number, so you can see even just with one partner, we can get there.
So you obviously, you've alluded to the fact that you've got 11 insurers, some big names there, certainly in the UK. You also, I think it was in March, you also incorporated LeakBot USA Inc. And obviously there was some general manager hires. I believe Jim Strickland was brought on as general manager for North America. How are things going out there? I mean, are you happy with the way things are progressing?
I'll be happier once we've announced more things in the market. Once we've got a few things over the line. That said, I am happy with the progress, and it's really exciting. Just the potential in that market is absolutely vast, and We've got the patents in that market too, and there's nothing else like our solution on the market. What we find in the US, Phil, is the carriers that we've pitched to, they've tested more things already in the US. They've tested the plumbed in systems, and they're often $400-500. They work, but they're just prohibitively expensive. Or they've tested these moisture sensors where they're cheap, but there's no kind of claim savings. So a lot of the carriers are almost a bit jaded by, we've been to this movie before, we've tried things. There's nothing really that works. But quite quickly we can explain why our solution's different, and they're, right, okay, I do understand why this is a different idea. And so I think what we've noticed is there's definitely a thing. I think it's probably the same in any B2B market, but it's definitely this case in insurance, is always a problem with getting the first one over the line. So once you get the first partner done, like Hiscox was a breakthrough for us in the UK. We signed Hiscox, and then you'd pitch to the next insurer and they say, well, if it's good enough for Hiscox, it's good enough for us. So there's definitely a peer thing, like, is anyone else doing this? So, I'm really excited about the prospects in the US. I mean, some of the biggest insurance companies over there are just absolute giants compared to anything that you see in the UK.
Any others? Somewhere like Asia? I mean, you're always looking at other regions as well?
Yeah, I mean, it's the thing that holds us back at the moment, Phil, is just cost of capital and resources. And at the end of the day, we're like 20 odd people at the moment. So we're still a small company. So there's huge interest from other regions. We've had, requests from Germany recently, from our biggest insurance company in Australia, asking questions about, when are you ready to launch? And the answer to most of those things at the moment is, once we got resources to look at it, we definitely will. But there's what we found, Phil, is with a new market, we need to do a little bit of homework. We found that when we first launched into Denmark, into Sweden, in the United States, we did a proof of concept. And I mean, did you know a lot of houses in the US, the water is fed off a groundwater well? I mean, it's stuff like that we just wouldn't have anticipated until we went out there and had a look. So we were approached by a massive insurance company in Japan recently, and even just having a quick look at it, we realized that, I mean, the plumbing in Japan looks totally different to the way it does in the UK. Like the pipes seem to run outside of the property and then in through the wall. There's huge global, opportunity for this solution around the world. It's definitely a global problem. I think at the moment, just the growth potential we've got in front of us in Scandinavia, in the UK, and in the US is, more than what we can handle already with our existing resources. But there's definitely massive opportunities beyond that.
So, in terms of manufacture of the devices, LeakBot, I mean, if Admiral came to you next week and said, we want to get another, 60,000-70,000 unit, sign up for another this amount, how quickly, have you got the manufacturing capacity to meet those demands?
We make the product in a factory in Bedford through a partner contract manufacturer. We've probably got capacity without spending any more capex for kind of double the current volume requirements. But we can expand the line basically just by adding more production cells. So I mean, any insurer, none of them move lightning fast. So we always, have a good 3 or 6 months lead time before we need to meet incremental demand that we're not forecasting for. So there's a way to expand the production lines basically just by adding more cells and without a huge amount of capex from a kind of manufacturing point of view.
Craig, based on what you've said and the contracts that are already signed, once that time frame passes over the next 3, 6, 9, 12 months, then you are going to be cash flow positive based on what you've already signed.
Again, I have to be really careful about making forward-looking statements. So I guess because the size and scale that we're at, we haven't put any forecasts out there. But I mean, our chairman, Mark Wood, has explicitly said that publicly about that's the kind of time frame that we're aiming for. So I mean that's good.
You can blame him anyway if anybody's got
exactly.
a problem. No, but based on what you've said, if you've signed up a Scandinavian insurer with 2 million customers and they basically want to give it to all the customers, now not everybody's going to take it up. Even 10% take up is going to mean that you will be cash flow positive. Never mind 40%.
Yeah, exactly.
40% is going to mean you have maybe 1 million units. And maybe that's going to take a couple of years to get there, but 1 million units on the model you're talking about is going to make you an extremely profitable company.
Yeah, and they're a fantastic partner in Sweden as well. And the really interesting thing about those guys as well is everyone else has focused on the actual claim saving has been the commercial driver. But they had an interesting model where they didn't have any email addresses, and normally we offer it over email. So they came up with a solution where we're going to send a postcard to our customers and say, hey, this is great for the environment. Scan this QR code. We'll send you this thing. We'll even come and fix any leaks. So that postcard had a 50% redemption rate when they sent it to customers. But what they also did is they did above the line marketing and also did direct mail to around the immediate neighbors. And as a result of doing that, they drove their new business sales by 50%. So 50% increase in new customers that they attracted to the brand, because they said, hey, look, existing customers are getting this. If you switch your home insurance to Lancer Schaffringar, you can get this as well. So it was a dead interesting, really interesting initiative. And from the CEO down, they're totally bought into making it a long run part of their business, which is exactly what we want.
You need to set your own insurance company up, Craig. That's basically the solution.
Well, I tell you one
conflict of interest there, would there?
Well, there's one really interesting development. So our core business is all about the insurance sector, and that's where all of our focus has been. But there was a really interesting development just recently where we were approached by Portsmouth Water, and they said, look, we've got problems with water efficiency, like every water company. We're interested to see if we can use your technology to drive water efficiency and demonstrate that to the regulator. So our first reaction was, well, this is not really our core business. Is this going to be a bit of a distraction? But we thought, well, we might as well. So they just took a couple of thousand units for a test. But on the back of that, it sparked a bit of other interest from other water companies. Now, water companies haven't traditionally been that interested in driving water efficiency. The regulators traditionally focused on them reducing leakage on their own infrastructure, so in the street and on all the industrial pipes. But the regulator works in these big multi-year regulatory cycles. So Ofwat, just a month or so ago, published their full regulatory guidance for the next regulatory period called PR24. And they basically kind of set the rules for the water companies for this next kind of time period. And some of the changes that they've made is they've actually put a specific target on the water companies to reduce consumption by 37 litres per day per household. So it's quite a hard thing for them to do, actually. So in acknowledgement that it's hard, they've also created £100 million innovation fund to pay for innovative solutions where you can utilize technology to deliver some kind of measurable result against that target. So we're now speaking to a bunch of different water companies. And what we figured out is obviously we've got units deployed everywhere. So we looked at it from a water efficiency angle instead of a claims reduction angle. And we've been showing water companies, well, look, here's units that we've deployed in your region, and 30% of them had a leak at the beginning when we fit the units, and we've got good data on the flow rate of the leaks. So it adds up to, this many, litres per day per house. And if you fast forward to right now, only 10% of the properties have got a leak. So we can work out exactly the leak reduction. And what we've proven is we can deliver most of that Ofwat target by deploying the units. So it's a really interesting spot right now, as all the water companies are getting their business plans ready to submit to the regulator. So it circles back, Phil, to your question on, was it you, Kevin, said you should be your own insurance company. The interesting thing about the water company model is there's a path potentially where we could deploy very high volumes of units, and every one of those customers we can ask when's their renewal date, and we'll know whether they've got a leak or not. So they're a really great risk. And if I ask any of my existing insurance partners today, hey, is that useful information for you? Do you want to pay for the repairs? If we find one of your customers, do you want to pay for the repairs? To which the answer is, yeah, great. I mean, normally I'd pay for the device. So if I'm just paying for the repairs, brilliant. What if we find someone who's not one of our partners? Would you like to market your insurance to that customer? Absolutely. So it's a really interesting development. And we're already making links with Ofwat and applying for various grants that they've got. And
maybe you could speed those guys up, because when you see the water leaks from the mains, it can be 2-3 weeks before they act on it as well. There's some frightening figure out. It's something like 1 trillion litres of water wasted through just through leaks every year from mains leaks.
Yeah, and I think what's happened is, the last regulatory period, they were really trying to focus the water companies on the leakage on their own infrastructure. But I think what they've realized is they've missed the point about quite how much leakage is actually on the customer side. And the killer thing is those, mentioned at the start of the show about the leaking overflows down the back of the toilet. Yeah. They waste about 400 litres per day. I mean, you wouldn't think it doesn't look like a lot of water, but they waste, 400 odd litres of water a day when one of those things is leaked. And the amount of houses that have got one of those things just constantly running down the back of the loo, and people, because it's not doing any damage, people don't really think to fix it.
So, Craig, a question we like to ask all CEOs, I suppose, and people in positions of management in the company: what sort of skin in the game have you got in this? If you want me to put my money in, have you already put yours? Yeah,
it's a good question. So, I put £220,000 in, more or less, at 12 pence a share when we did the RTO. Interestingly, every single one of the senior team put their own cash in and bought shares. If you add up all the senior team and the board directors, between us, we've now bought 12% of the current issued share capital. Significant skin in the game, and we're in this for the long run. And obviously, you can tell from that we all really see the long run potential in this business.
Yeah, and we can see it as well. And the company that it came out of have got 20%, is that right, as well?
Yeah, that's right. Yeah, HomeServe owned 20%. So, as I mentioned earlier, they've been bought out by Brookfield, and we've already made friends with those guys. And they're, very invested in our success. They want it to work, and they see the potential in the business as well. So they're happy sitting there with their 20% as well.
Just looking at the share register, and I see a certain Gervais Heddle owns about 4%, which is always quite reassuring to see someone who's lauded in this small cap industry.
Yeah, Gervais has been involved since the beginning, but he's steadily been building his position. Actually, we put a TR1 announcement out a while ago because he went over the 4% mark. And, I spoke to Gervais a couple of times, and he really gets it. And I think he sees an opportunity because I think he thinks he's got the story ahead of most people. So I think he sees just how big this business is going to be. So it's really good to have someone like him, as a supporter.
Yeah, I can really see that this could be a dividend-paying utility stock, effectively, because the risks are just minimal in terms of nobody's going to change the tech once they've done it. If the insurance companies are saving the money on an annual basis, there's less and less water damage to the houses, which is going to make the insurer and the insuree much happier. Then I don't see that there's going to be much disruption in this business.
Yeah, no, I agree with you, Kevin.
So just to sum up, by the looks of things, you're well on track to become cash flow positive in the not too distant future. You've got a market cap of 4.35 million. You came to the market much higher than that. Seems like an idea that's gonna work. And this is all about sausage machines. No, this is all about the number of these units you put out, the more profitable this company is going to be.
Yeah.
So you hit 1 million units, you hit 2 million units, you hit 5 million units, which might be 5 years from now. It might be 3 years from now. It might be 2 years from now. Who knows? But 5 million units at £20 a year, you do the maths. That's a lot of money.
Yeah, it's a very good summary, Kevin.
Good. Well, I think on that note, I think we've talked long enough. Obviously, being that this is the Sunday roast, Kev's got a question for you, I guess, on that, being the foodie man.
Yeah. So, what would be your Sunday roast of choice, Craig?
Oh, always my preference would be a roast chicken. But do you know what? My grandma was German, and she always used to do cream spinach as a side with our Sunday roast. So when we have it at home, we always have cream spinach, which is, for a Brit, it always seems a bit of an odd choice, but I keep converting people to it. So I highly recommend cream spinach with your Sunday roast.
And chicken. I haven't had that many people with chicken. Lots of lamb and lots of beef and chicken. But chicken, you can't beat a good roast.
It's traditional, though, isn't it? It's a good traditionalist. Well, on that note, we'll say thanks very much, Craig Foster, CEO of Ondo Insurtech. It's been a pleasure.
Thanks, Phil. Thanks, Kevin. Thanks for inviting me on.
Thank you.
It's certainly an interesting story, and look forward to welcoming Craig back on in the future as he updates the market. But How's the week been? Other than that, what have we seen this week? The movers and shakers. Tuesday was a good day because we got the announcement that Prospex Energy had gone into a gas sales agreement with BP Gas Marketing. And obviously, we had Mark Routh on, and I thought that was very welcome news. And obviously, I think the podcast, the feedback was very good. We had Fulcrum Metals who came to the AIM market and had their first day of dealings on the Tuesday. So it was always good to see new junior exploration companies that they're based up in Ontario, in Canada. Anything else? Technology Minerals. What are your thoughts on that? The update on the EA license for the Wolverhampton plant for the lithium-ion battery plant there.
Yeah, it can't happen soon enough. Obviously, been a bit of a delayed reaction. I think the RNS was on Wednesday, was it? And nothing much happened, or maybe Thursday. And then the volume came in on Friday, and it went up a bit. To 130 to 140. I think 140 was paid on Friday. It's still absolutely priced to fail. Like, it's ridiculous that nothing's priced in. On license, if this is the way it works, it should be, it should bag on license, if not more, because it's absolutely crazy. The license is coming. It's just a delay. I mean, it's been delayed for 9 months probably, and that's the frustrating part about it. And we're still waiting for the lead iron ones as well. So when they get them both, which I'm pretty sure they're going to get them both in the next, let's not put a time limit on it, but before the middle of the year, and maybe long before then they're going to have pretty significant revenues coming in from both of these in the second half of the year.
Yeah.
And it's going to transform the company and transform the revenues available.
I was pretty shocked, not shocked, but I was pretty surprised that it was on the lithium ion back plant, not the lead acid one, because obviously we've seen how more, I won't say more advanced, but we've seen the equipment there ready to go, literally flick of a switch with the feedstock. Whereas the lithium ion one was slightly less developed in terms of, obviously all the equipment was there, but it looked like it was a little bit later stage. But that's nice to see that one has been given, or they've had the update on that plant.
Yeah, no, I agree with you. But I think both of them can produce revenue very not quickly, but within a short period of time. I mean, the lead ion is already producing anyway. Lead acid batteries are already producing revenue, which should be keeping the company basically cash flow positive based on what they were trying to achieve on a monthly basis, paying the wages and all that type of stuff. But then as soon as these two things start, it's off to the races, basically. Yeah. So we have this as one of our stocks of 2023, and it's currently this one of only one or two, I think, stocks that are actually down. We won't do a review of them now, but just give you an overview that the stocks are currently up 13% since the start of the year. So that's not bad. Best performer, I think, has been Chill Brands, and worst performer so far has been Tech Minerals or Jubilee. They're both pretty similar.
They both had news this week. Chill Brands obviously had the announcement on Wednesday, or no, it was the announcement on Thursday, the commencement of the third-party sales. What did you think of the announcement?
It was absolutely mad. Or was it mad tasty? I thought it was brilliant, to be honest with you. I think my impression of Chill now is a turnaround story. I never really lost the faith, but at the same time, we met Callum in London, didn't we? When was that? November? Yeah. October. And he's a very enthusiastic guy, and he does know what he's doing. He knows that he's got to try and bring revenue to the company. And I can see that, in that RNS, it stated that there was 5 others to be added. So there's 5 other lines to be added. If we can get any type of sales going through chill.com, it's going to mean the traffic increases exponentially with all of these different brands on there. That's going to mean more sales of Chill products as well. And also they're going to get a healthy cut on many of these products, 30%, 40%, maybe some 20%, but on average 30% of the revenue. So, and really all they're doing is hosting it. So Yeah, it's a company changer. If that was the only thing they were doing, it would probably would be worth more than they're currently worth as a market capitalization. So yeah, as it's not the only thing they're doing, and vapes are arriving, I think, any day soon in America, and they're going to be going out to the stores. And there's a big hole to fill there, isn't it? In both in the UK and in the US with all these different vapes that have been causing problems with the nicotine, and also just cheap vapes are blowing up in people's faces, and
popcorn lung and all that rubbish that happens. Yeah, absolutely.
Yeah, so I mean, I think people are going to have to be a bit more cautious on buying the real crappy ones and start to buy something that's got a bit more tech behind it, if you like, and also is not going to do your health any harm because it's just a flavor.
The other one this week, which moved very well, I think it did circa, was it probably about 40-50%, was Clontarf Energy. Clontarf Energy announced the head of terms for a direct lithium extraction DLE pilot facility in Bolivia through a 50-50 joint venture with Next Chemex Corporation. The pilot plant will process 20,000 litres of brine in a trial run. Clontarf Energy will provide $500,000 to the JV to fund the construction of the plant. So that had a really good week. The Rockfire Resources, I don't know, we've talked about Rock before, haven't we? Rockfire have completed an additional 2 geotechnical holes at the Malawi zinc deposit in Greece. The company said that they had encountered massive sulfides in the holes and uncovered the strongest visualized mineralization at the project in one of the holes, and the drill program continues.
The other two that I was looking at are both coal related, and we had news from last Sunday, obviously, when we had Carl when he was in Zimbabwe for Contango. So there was pictures there on social media that I think the wash plant is now sort of 75% constructed. A few other things are still to happen, but 2-3 weeks time, I think it was, that they're going to start putting coal through. I think the machine had arrived as well. This 500 tons an hour coal cutting machine, which they've ordered and has arrived on site. So, I mean,
good, yeah. The updates.
I think everybody's just, what are they waiting for? They're waiting for revenue. But I mean, the reality is it's coming, So I think, from the point of view of that and the share price, it's ridiculous, to be honest. The share price is way too low for the stage that it's at. But I think there's been many delays and people are a bit skeptical, I think, but let's hope that picks up. And the other one was Ben's Creek. We've seen a consistent rise in the high vol B price over the last week and a bit. I think it was up to 305 or 310 maybe was the last price.
Yeah.
So we're comfortably over $300 a ton now. And every dollar that's added there is going to make Ben more profitable every year, and significantly more profitable as well. So again, obviously they had placing there. They placed some of the shares that were held by MBU Capital at 18p, but it's sort of recovered from that now up to 22, I think, and I saw 22.5, I think, at one point.
Yeah.
But again, it didn't have any of the things that's going for it right now this time last year, and it was higher this time last year. It didn't have production, it didn't have the railroad, it didn't have, and it's now 22.5p. is bizarre. It really is completely and utterly disconnect in terms of, they shipped 54,000 tons in January. So let's assume that they had, $100 margin on that. That was going to be $5.4 million of free cash flow. And yet the share price is still where it is. And that's in 1 month. That doesn't make any sense. It really just doesn't make any sense.
The other one that's popular with retail investors is Barron Oil. They had announced a CPR for the Dunrobin JV with Rebold Resources and Upland Resources, located in the Inner Moray Firth. Barron Oil has 32% interest in the license, and the CPR confirmed a midpoint gross unrisked prospective resource of 201 million barrels of oil. Management expect the first exploration well will be drilled in the western section of the license once funding is secured. So quite interesting from them. Obviously, that their main assets being in the Chudich in Indonesia there, where Shell have previously drilled. So quite interesting, and it does seem to be a real favourite with retail investors. That one, there's a massive group. I think one of the Telegram groups has got around 800 members in it, so a bit of a firm favourite for the retail punters there.
The last one, which I don't think we did mention there, was and really it's very clear in my mind because of us visiting Zambia, was Jubilee. You know, they had a 6-month update, and it basically showed that they'd had problems in South Africa and in Zambia. Share price got smashed by 25%.
Yeah, I didn't understand that because they've overcome a lot of those. We had Leon on, didn't we? And they'd actually overcome a lot of those hurdles. I thought he was very upbeat and very, very bullish on the future, because it's actually, they've learned a lot from those challenges, haven't they? And they've overcome a lot of the water issues. They've overcome a lot of the electricity, obviously the load shedding. They've got supplies of electricity going directly to site now that's going to be uninterrupted. So yeah, I think that one will do well from these levels.
Yeah, and on Friday they had another RNS, which was basically saying Leon, Colin Bird, and one other director had also bought a significant amount of shares. So I think the three of them together had bought about 1 million shares. So if that's not a statement of intent, I don't know what it is, because they're basically saying it's way too cheap, and I think it is way too cheap. So yeah, it's one to have a look at.
Good. Anything else for for the next week? Anything planned? Anything going on? Or just same old? Same old.
Hopefully, after Liverpool's win in the derby, we can actually start to play football again, which would be very entertaining. And a week ahead where we've got Newcastle and Real Madrid, and it should be entertaining. I understand Rashford was unplayable last
very good,
Thursday night, was it?
That was.
I didn't even hear the result.
Yeah, it was. Well, they were 2-1 up. They were 1-0 down. Then it was 2 goals. It was like, I felt like I was reliving the 99 Nou Camp situation again. It literally was 1-0 up, and then within about 2-3 minutes there was 2 goals, and then they equalised. The usual United took the foot off the gas, bang, goal in, and yeah, it was a good game. We've obviously got the replay. Let's do them at home.
Yeah, it was 2-legger thing now, isn't it? So you got to beat them at Old Trafford.
Anyway, on that note, shall we wrap things up and say have a great rest of the weekend, and we'll catch up with you next week.
Indeed. Enjoy.
This podcast was brought to you by Roast PR Limited. If you would like to appear on a future episode of The Sunday Roast, please email admin@thesundayroast.net.